Thanks, Dave. Thanks, everyone, for tuning in today. There's a lot of great speakers in the festival today, and I'm happy to be kicking things off talking about the futures markets and more specifically, day trading the futures markets. We'll look at a handful of the tools that I use to day trade on a daily basis. We'll walk through some trade examples, and I'll do my best to take some questions and answer questions as we go here. So, as Dave said, it is being recorded, and let's dive right into some of the things that we're going to cover in the next 25 minutes or so. So, I want to give you 3 simple tools that you can use for day trading. You can also use these for swing trading, but we're going to kind of focus on the futures markets for the next 25 minutes or so. A super important part of trading is being able to identify the trend so that we can identify the change in trend and where the trend is changing. When that trend is changing, you've probably noticed, that's when there's a host of opportunity. So we'll talk about those two in conjunction with each other, identifying the trend and identifying when the trend is changing so that we can kind of be the first ones to either get into a new trend if you're a trend trader, or get out of kind of a dying trend, or if you're looking to fade the market, perhaps just identify that the trend is shifting. And then one thing that's super beneficial, we'll talk about not only just how to get into a trade, but how you can actually stay in a trade longer, stay in a winning trade longer, because it's easy a lot of times to see a setup or to place an order, but being able to stay in that trade and ride it out with the most amount of contracts on, while at the same time, reducing your risk along the way. I'll give you some strategies for doing that as well. And then we'll kind of tie everything together with this trade management approach that you can do, regardless of whether you use any of these kind of tools that I use for day trading. You'll be able to take away some things that you can apply for managing your trading positions. So for those that are unfamiliar with myself, my name is Tim Racette. I am it's my pleasure to be able to speak and kick things off today. I've been trading since about 2006, and then I made the switch to full-time trading in 2009. I'm originally from the Chicagoland area, and now I live in sunny Arizona, although today it's not quite so sunny. It's been getting quite a bit of rain, which has actually been really nice. So I see there's quite a few folks from overseas and all kinds of different places. And thanks for taking the time out of your morning, afternoon, or evening. So I got my start really swing trading stocks, and then I kind of migrated over to options, as a lot of people do when there's this lack of or a need for additional leverage. And so then kind of the natural progression from there, as we go from swing trading, maybe longer term positions, to moving down to the smaller time frames, futures is a natural progression. And when I first started trading futures, I was already having a lot of success swing trading the stock market. And I really struggled those first 6 months day trading, and I was trying to, do too much in a small capacity. The markets are open 24 hours essentially. There's so many inputs coming at you all day long, from news to indicators and various things, and I was trying to combine too much. And so by simplifying and pulling a lot of the techniques that were already working in my swing trading, that's what really led me to a really sound futures trading approach that I've been using now since about maybe mid 2008. So in addition to trading and being in front of the computer for a good chunk of the day, I like to get outside. I'm a avid mountain biker, and I spend a lot of time hiking and exploring, especially throughout the summer. As you can see there, I'm a ASU Sun Devil graduate, and spend a lot of time trying to travel and just kind of get away from the screen as much as I can, because I can't think of a time where I've been sitting in front of the screen during market hours where I had one of those light bulb moments or something clicked. It's always been, after hours, away from the computer screen, on a weekend where I'm doing something completely unrelated to trading, and that's when one of the pieces kind of fits into place. So you can find me in all the usual places: Facebook, Twitter, and I've got tons of videos on YouTube if you just search for E-mini Mind. So that's a little bit about myself and kind of my background with trading. I know a lot of people kind of get interested in the markets through individual stocks, and making that progression is good. I always encourage people to begin trading by looking at daily charts and swing trading, because you develop a lot of good habits through the process of having to wait for the entire day to close before you can really make any decisions. You're not looking at the intraday chart, you're just looking at the daily bars. And so when I combine, starting with stocks to combining that approach with the mentors that I had down at the Chicago Board of Trade and folks that had been trading on the computer screen since the 80s, really encouraged it, the younger folks like myself at the time to, you don't really want to be down in the pits. They're kind of dying, and there's not as much arbitrage and things that are allowing for profitability. You want to be on the computer screen. And so on the computer, trading was where I went pretty quickly after going down to the Board of Trade. And so having some really sound trade management techniques taught to me by folks who've been doing it for a long time, two traders in particular, is really kind of shaped my trading. I don't really believe that you need to go through a huge period of losses. Sure, there's going to be ups and downs in your trading, and sure, you're going to lose money and you're going to make money, and sometimes you'll get lucky and you'll lose, you'll get lucky and you'll make money, or you get unlucky and you'll lose money. But setting some parameters, kind of a sandbox, if you will, so that you don't let one day or 1 week or even 1 month kind of destroy your whole trading account, is really critical. So let's get into kind of the meat of how I trade the futures markets and talk a little bit more in depth about that strategy. So one of the first tools that I use is called a tick chart. And a tick chart is just another time frame. So we think about a 5-minute chart or an hourly chart. A tick chart is just another way to look at the market over a period of time. But instead of time passing by and your bar closing after, say, 5 minutes or 15 minutes, the tick chart forms after a certain number of transactions. So after a number of trades take place, then the candle closes. So it's just a slight variation. If we look at the chart here, you would look at it and you'd say, oh, that looks like, it could be a daily chart. It could be a 5-minute chart. But it happens to be a 512 tick chart. And so it's just a slight variation on the way that I interpret the data. It's derived from price, and it's really helpful because when the market is forming a lot of trades really quickly, when there's a lot of action happening in the markets, the bars form quicker because the number of trades are coming at you faster. And so with just looking at a tick chart, you can kind of get a sense of the volume that is in play for the day. And these indicators, if you will, or variations of looking at the market are really available on across the board on different platforms. There's nothing proprietary or custom that you can't get on any platform, whether you're on Thinkorswim, TD Ameritrade, TradeStation, NinjaTrader. All of the platforms have a tick chart. So then the next variation that I use, and you'll kind of see that the theme is not kind of doing exactly what everyone else is and looking at the market as everyone else does, kind of have these slight variations to see things just a little bit differently. But I use what's called a Heikin Ashi candlestick chart. And so instead of a traditional candlestick chart, the variation comes from the opening price. So a traditional candlestick has an open, high, low, and close. And the Heikin Ashi, instead of opening where the prior candle closed, it opens the midpoint of the prior candle. So here is a traditional chart on the left, and the right is a Heikin Ashi variation. And you can look at the chart and you can see the trend. It's pretty clean. But it really gets clear when you put the Heikin Ashi, because each candle starting at the midpoint of the prior candle. And it's just a way to visually clean up the chart a little bit. And it helps me, especially at first, it helped me identify the trend much quicker. To Neil's question, in terms of the time-based charts, we've got tick charts, traditional time-based charts. There's also range bars, Renko bars. There's a lot of different variations on sort of that x-axis, if you will. And I haven't looked at the other ones like range bars too much, but I found that the 512 tick chart for a market like the E-mini S&P or the NASDAQ is a fantastic way to get enough information that I can place trades, but it's not so much information where the chart's just a big mess and a whole bunch of noise. So the colors, whether they're red and green or black and white, they just kind of help give me a little bit clearer direction. They also help the trend become a little bit more obvious. So when we combine those two together, when we take the tick chart and combine it with the Heikin Ashi candlestick study, just right on top of each other, merged into one, we get this really good visual representation. It's easy to identify those trend changes. So again, here's a traditional on the left, and then here's the Heikin Ashi candlestick on the right. And you can pretty easily identify the trend on the left part of the chart, on both charts. But as we get into the sideways consolidation, it becomes a lot clearer when we can see that, oh, okay, there's only 4 or 5 bars in one direction, then 2 in the other direction, then only 3 green bars in one direction, then we pull back and trade in the other direction. And the color-coded bars are just the ability for that smoothing of the trend really helps to clean up that transition between trending and range bound. So that kind of leads us towards, okay, that's great to be able to look at the chart in that way, but how do we clearly identify the trend so that we can know, where to place trades? And so everything kind of comes down to that basic market structure. We know that the market doesn't just go straight up. It kind of stair steps its way up, or it might move up a little bit and then pull back. And so you end up with this series of steps, or just kind of a back and forth movement. And so a traditional typical day, market might be moving down, and then an hour into the day we change direction. And so all of these movements and things are driven by just our emotions: fear, greed, fear of losing money on the trade, fear of losing profit on the trade, wanting more profit, and so that influences our buying decisions and selling decisions. We kind of all, agree upon that. And then most of us know that, a trend is made up of higher highs for an uptrend and higher lows, and a downtrend is made up of lower highs and lower lows. And so when we can quantify some of that, and we can actually put it on paper, going through printing out a 5-minute chart of, the NASDAQ, if that's the market you're trading, print out that 5-minute chart for the day, go through, mark the highs and the lows, and then, relate the current high to the prior one. So what we end up getting is, where is this current high in relation to the previous one? Okay, well, this one on the right is higher than the one on the left. And this one here on the left is just a little bit higher than the one to the left of that. And same with the lows. And so then you end up charting these or annotating the highs and lows. And we get into this situation where we have higher highs and higher lows, lower lows and lower highs, but it's this important area where we change from lower lows and lower highs to higher highs and higher lows. And that's what we're interested in terms of capitalizing on that trend change. So let's talk a little bit about getting into the trade. What I like to do is to simply wait for a break of the swing high or the swing low. So if we look at that, look at the chart again, I've got the prior swing high marked here, and you can see that this high is higher than the prior one. So we could be in a downtrend over here to the left, and when that swing high breaks, that's a sign that, oh, okay, we might be changing trend. So then all I do is wait for the market to come back. I use a very basic Fibonacci tool, and then I use, it's not a Fibonacci number, but the tool is helpful just to see where halfway back is, letting the market pull halfway back. That was a big thing down the trading pits, drawing the first hour's range, high and low, and looking for where the halfway back point was, and looking to get into the market there. And so by doing that, we're essentially letting the market pull back a little bit. We've established that a new trend could be starting. Market pulls back, getting in the trade at that 50%, and then riding the trade in that new trend. So we'll look at that same chart in terms of getting into a trade. Like I said, on the ES, I'm using that 512 tick chart. I use a 6 tick stop, and I try to get that stop to be below the 61.8% line. So here's that same chart. The top line is that 50%. This is that swing high over here that we broke to the right. Let it pull back to the 50%. I put my initial stop below the 61.8 and try to make sure that that's about 6 ticks. And then from there, it's easy. If the trade doesn't go in your favor, you just get taken out by your stop. But when the trade does go in your favor, and you've probably experienced this where, you're up 3 ticks on the trade and you get nervous, so you bring your stop to break even, and then you get taken out, and then it rips without you. Or the trade moves 3 points and you just kind of leave your stop at where it was or move it to break even, and then that 3-point winner turns into a break-even trade, or even worse, a loser. So I've got a couple trail stop methods that you can use. You can use them on day trading. I use the same approach on swing trading, so it really doesn't matter. The first one's a little bit conservative, and what I like to do is trail, if I'm long, below swing lows. So anytime the market pulls back like this, it could just be a couple of candles, or in this case, 1 candle. Market pulls back and then it makes a new high. I'll just keep moving my stop 1 tick up below that swing low. So we make a new high, we pull back, make another new high. You can just keep moving your stop up under the swing lows. And the opposite for if you're short, just trail the swing highs. But it's a great way to let the market tell you when to get out. This is something that I began doing on daily bars with my swing trades, and it's the exact same approach that I've used since 2007. Very early on, I started doing that. So that's kind of more conservative because the market has to pull back and then break out. And then there's this period where the market, in this example, starts moving really quickly. So my stop's way down here, but price is up here. So you say, well, I don't know if I want to risk, this could be 3 or 4 points in some cases. So what do I do when there's no pullbacks? In that case, I use a little bit more aggressive approach. And what I like to do is trail each candle's low. And again, you can go to Apple or Google and just look at the daily chart. Or and I've got trades on in Abbott, ABT, and Cigna, CI. Those are good examples right now where they were trending nicely, and now they kind of went straight up. So in this trade example, when the market starts going straight up really quickly, rather than getting scared out and just, oh, I don't know what to do, hit the flatten button, or a lot of times it happens to the downside on a day where we're tanking pretty good. You just kind of get scared and you drag your order in and you get filled and you're out of the trade and your heart's pounding, and then it keeps going another 5 points. Rather than capping it off, just if the market starts moving really quickly, just start trailing each candle's low, and then eventually you'll get stopped out when it breaks the prior candle's low. So to kind of tie all of those things together, we've got this tick chart and Heikin Ashi candlestick that really help give us the visual picture, just a slight variation on looking at the market to be able to interpret that data. It helps us identify the trend so that we can be looking for places where the trend might be changing. And then when we can identify that change in trend by way of a swing high or a swing low break, then we can identify, okay, this is a good spot to be looking for trades. And whether you use a 50% retracement or any other kind of entry, just being able to identify where the trend is about to change or likely to change, you can use whatever method you want to get into the trade. What I like to do, though, is to get into the start of a new trend as soon as I can identify it. Or if we're in a bigger uptrend, maybe we just make a deeper pullback and then we can get in on a resumption of the trend, as opposed to just seeing the market go up and then chasing it, trying to jump on at highs, getting stopped out, it comes back down, and then you've been selling to the or you've been buying to the person who was long already, who is selling. For the most part, I'm only using tick charts and Heikin Ashi when I'm day trading. I don't look at tick charts or Heikin Ashi on the daily charts or my stock charts. So this portion is very specific to my day trading. For my entries, I like to get in at the 50% retracement. And then when it comes to managing the trade, again, this can be done on any time frame or any market, trailing those swing lows and swing highs, which if we come back to the trend itself, if we're using the swing lows and swing highs to identify the trend, well, that seems like a great place to be able to identify when the trend is failing or changing. And so by trailing swing highs in the shorts or swing lows in longs, you can stay in a trade. Sometimes I'll get into a trade in the morning on the ES or the NASDAQ, and just by trailing swing lows, you can stay in a trade for a couple hours, and you're don't have a lot of risk on because you're constantly moving your stop. You're giving it a little bit of room to move on, but you're locking in profit on the way up or on the way down. So then the other approach to managing the position, if it starts moving really quickly, or I'll do this on daily candles a lot, is to just put my stop 10, 20 cents below the prior day's low. And then if we make a new high today, then I'll move my stop underneath today's candle. Or if I'm day trading and the market all of a sudden starts moving super fast, I'm dragging my stop up on my trade ladder, and it's a really good way to tighten my stop and make sure that I'm still giving it room to run, even if it's just an extra point or two, as opposed to just hitting the flatten button or just close out of the trade. So one good way to determine, well, okay, that's great. A tick chart, sometimes you might use a 5 minute, sometimes I use a 15 minute, sometimes I use an hourly chart. So when we're talking about tick charts, how do you know what number to use? 512 is a good starting point, and most of the numbers are broken up into almost like old binary computer numbers. So you've got like 144, 233, 512. And so those are kind of the standard numbers. And if you start with 512 and see if there's a lot of activity, and if you're getting a decent amount of setups, then stick with that. If there's not a whole lot, like on the euro right now, in the last couple of years since they've moved to half pips, you kind of have to go down a little bit, and then I use a 233. So I know there was a ton of information packed in there, and as Dave said at the open, it's being recorded, so you'll be able to review everything that I talked about. I'll try to run through a couple of questions in the last minute or two here. And if you want to find out more about myself, or if you have specific questions, especially to your own trading, I got my email up here, tim@emoneymind.com. And I also have a whole bunch of free stuff over at emoneymind.com in terms of my trading strategy and videos, things like that. And I also have a monthly membership where I do a live kind of group trading room where we get in there and talk about the markets live on Tuesdays, and a whole bunch of kind of trading instruction and videos that I put together to help walk you through this style of trading for day trading, mostly focused on the futures markets, but I also talk a little bit about swing trading and the other trades that I'm in, and things along those lines. So I hit a few of the questions. Just running through a couple of the ones that I missed here. I try not to trade in the first 15 minutes, especially on the ES. I like to let the market settle out a little bit, and then after about 15 minutes, then I'll jump in, and then you kind of have some highs and lows established. You have a little bit of time for the market to digest any overnight news, and so it's a really good way to not blow up in the first 15 minutes and keep a little bit more patience throughout the day. There's a whole bunch of different ways to look at the markets and tools out there and indicators. So the one takeaway I can strongly encourage is the simpler you keep things and the more that you continue to simplify and clarify your own trading methods, the better you'll do. The less you'll have going on in your head, the less things that will be required to place a trade, and different things pulling at you in different directions, and that will make the hesitation subside and the fear subside. If you can continue every week to look at your trading screen and say, okay, is there anything I'm not using on my screen to either get in a trade, manage a trade, or determine if this is a good place to get in, manage, or exit a trade, then get rid of it. And you can write some things down. You don't need a huge 15-page trading plan. Start with a legal pad and write some notes down. Pick a daily loss limit, a weekly loss limit, and start to create some parameters so that as you go from practicing on a sim account to a live account, that, okay, I'm going to give myself $500 daily loss limit and no more than $1,000 daily loss limit for the week. And that's really helpful mentally to be able to have that parameter set. So I want to thank everyone for tuning in today. We've got a lot of great speakers ahead of us here. And as always, thanks to Dave, Festival of Traders. And if you have questions, you can reach me at tim@emoneymind.com. Thanks, everyone.